Welcome to the three paths of lending. This is going to do like a deep dive into how people are able to get access to capital and how you guys can make extra money and also get funded. This is the agenda, the three paths of lending. All right, there's credit-based lending, revenue-based lending, I should say lending. You can say lending or funding, doesn't matter, or asset-based lending. So credit-based funding is obviously based on the business owner or whoever's trying to get funding credit. Revenue-based funding is solely based on the income that the business is producing. Now, credit is not the end-all be-all of revenue and asset, but it does play a part. Okay, so credit is always there because lenders aren't just going to give you money if they don't see that you have some sort of payment history. Okay. And then there's asset-based lending, which is basically like for vehicles, houses, equipment, and all that kind of good stuff. So first, we're going to obviously talk about credit-based funding. Okay. So there's personal credit and then there's business credit. These are two separate things. A lot of the times business credit can be solely based on the business, but if the business does not have an established credit profile, then it will come back to the personal credit. Two, it's going to be revenue-based funding. Okay. So these are going to be revenue term loans. So based on your business's, how much money they're making, revenue lines of credit. So a lot of people are always asking me, hey, how do I get lines of credit? Well, if you're going to get a line of credit, it's going to be based on the revenue that your business is doing. And even if it says that it's a line of credit, it's still going to be based on how much revenue the company is making. Merchant cash advance. Merchant cash advance are actually the newest type of lending that is in the lending space. And it mostly came about because during COVID and other times, there were a lot of private investors that had a lot of money sitting on the sidelines that they weren't able to necessarily give people regular loans. So they said, well, look, we don't care about your credit. We don't care about what your business is doing. All we care about is the cash flow. So they'll basically lend you money based on how much transactions your business has been consistently doing. That's what a merchant cash advance is. And, just so you guys know, these are like the payday loans of the business industry. So a merchant cash advance is really, really typically high interest, but they don't care about your credit. They don't care about anything except for how much revenue and how much money flows through your business. And they'll base your MCA or merchant cash advance on that basically. Purchase order financing. So purchase order financing is like, let's say you have a contract with Walmart and you need money to fulfill that contract. So as long as you have the contract signed and it looks bona fide and it's legit, the banks will lend you money to fulfill that contract so you can do it. Okay. Account receivables, small business, that's the typical SBA loan that the government gives. Oh, and the number 7 down here is supposed to say personal loans as well, but it looks like it fell off. But these are the revenue-based funding. Now, the small business SBA loans, they do make you look at basically everything. They'll make you look at your credit, your revenue, your assets if you have it. But typically, these are all based on how much money you're going to have, how you're going to pay it back, and so on and so forth. And then we have the asset-based lending. So this is going to be for real estate loans, equipment financing, equipment leasing. You can also get, if you have a large stock portfolio, and this is what the super rich do, instead of cashing it all out and having to pay capital gains tax, you can actually get a loan or a line of credit based on your portfolio. Same thing with a 401k. Let's say you have a large 401k because you've been working forever and you don't want to pull it out because you will get hit with a penalty. Well, you can actually get a loan or a line of credit against your 401k. And this is what an asset would be. And then settlement financing loans is like for paying your lawyers and, if you're getting sued or something along those lines. These are some terms that you guys should all know. Working capital loans, pretty much the same thing as an MCA loan. Startup business loans. So these are the ones for people that are trying to start a business. And I've been doing a lot of research on how to get more startups funding. Typically, when I'm trying to fund a startup, I'd go the credit route because you don't have any revenue yet. But there are certain banks out there that if you have a good business plan, you have to have good credit still. You can get startup business loans. Okay. And these can also be from private investors and other stuff like that. Micro loans, just smaller loans, franchise loans. So this is like if you're trying to start up a Subway, right? I know exactly how much money you're going to need to start up the Subway. I know how much all the equipment's going to cost. I know how much you're going to need to put down. So that's what a franchise loan would be. Business acquisitions loans. This is to buy businesses. This is to purchase a large business, and it can be really based on the asset. So you can actually do seller finance to buy businesses, and you can get sometimes some sort of funding to basically pay off the old business partner or to get the business going, right? Venture capital loans. So this is if you have investors that are interested in partnering with you, they'll give you a loan. Or if you have enough investors that are already backing your product, you can get a loan based on that. Short-term loans, these are obviously typically, 30, 60, 90 days. Sometimes you can get like a 6-month loan and it's considered a short-term loan. Long-term loans, these are for, 7 years for houses and things like that. Commercial loans, so this is for large commercial properties. Conventional loans, same thing as just a regular loan. Home equity line of credit, and a business grant. So business grants are the only one in here that you don't have to essentially take on a ton of debt. Business grants are usually given by the government, or some people have not government based. It's basically money for individuals to start their business and to get going. I do actually have a really good video on my YouTube channel about grants if you want to learn more about grants. But let's start with understanding what the underwriters, aka the gatekeepers, are thinking. Okay, so whenever you go to a bank, whenever you apply, typically nowadays it's an automated system. But if you're trying to get a loan, there will be an underwriter there, and they are going to review your file to make sure that everything is legit, because the bank's job is to mitigate risk, right? So whenever you have a new file for yourself or you have a file for a client and you're going to go and get them funding, there is going to be some sort of underwriter, whether it's an automated system or it's an actual person in the bank reviewing your bank statements, reviewing your credit report, and making sure that everything is good to go. So let's start to think like an underwriter. Into the mind of the underwriter: if, what, when, where, how. Okay, this is what the underwriter does. They think, how are you going to pay back the funds? That's the main thing they're going to look at. And it's not as simple as just like, oh, they have some money. No, they want to know everything you're going to do with the money. That's why when you actually go into applying for a loan or a credit card or anything, it typically asks you, what will the funds be used for? And there's two things that go into that. Number one, they want to make sure that you're not, just going to go throw this money away. But number two, they also want to know, they also have a certain amount of money inside of their reserves that they can lend out for certain things, right? So they have a certain amount of money they can do for home renovation. They have a certain amount of money they can do for debt consolidation. They have a certain amount of money that they can lend for automobiles, houses, all that stuff. They have a certain amount, right? So if you watch some of my videos on people who have bad credit that are trying to get loans, people who are doing this or that, there's certain categories that you have a higher probability of getting approved for that loan. Now, I don't recommend ever lying to the underwriter, because they're probably going to ask you, what are you going to use the money for? And you want to have your story straight, okay? So they're always thinking, though, how? Right? How are you going to pay the funds back? Show the ability to be, how are you going to basically have the proof that you can pay back the loan, right? So this is going to be your bank statements. This is going to be your tax returns. This is going to be your personal credit, because you have proof of making payments, so on and so forth. And then they're also going to be wondering if you don't pay the funds back, what are the consequences of defaulting on your promise? If it's an asset, they're going to take the house back, or they're going to take the car back, right? That's how they're going to pay if you suffer. If they don't, they're going to have to go after your credit, if you don't have any skin in the game, so on and so forth. So the consequences of if you don't pay it back, and then if you default on your promises. So this is what the underwriter is always thinking. How are you going to pay it back? And then if you don't pay it back, what's going to happen? How are we going to recoup our money? So now we're going to go into the different kinds of loans and the different kinds of funding that you can get. Okay, secured versus unsecured. A secured loan is backed by collateral, meaning something you own can be taken by the banks if you don't pay the loan under the agreed terms, right? An unsecured loan does not require any form of collateral for you to qualify. And obviously the upside and the types of secured loans are going to be vehicle loans, mortgage loans, secured or savings, right? So like if you get a Navy Federal bank account, you can put a lot of money into their savings, and then you can get a secured loan with your savings account backing the loan, right? So that's what it would be. Secured loan, same thing. Secured line of credit, meaning you basically have money inside your bank, and like you basically are going to put money on the card to buy it, right? So when you're starting a business or you're starting your business, your credit card journey, you want to get a lot of secured credit cards. where you basically put the money on the credit card and then you would use it as a typical credit card. Same thing with line of credits, car title loans, basically using the car as collateral, and then pawn shop loans at the bottom, where you basically drop something off at the pawn shop, they use that as collateral, and then they loan you the money. All right, unsecured loans, student loans, till death do you part. Personal loans, unsecured credit cards, and lines of credit. So typically, whenever we're doing funding, we want to go for these unsecured loans because we want to basically put it all on the credit report or put it all on the business, because there's nothing that the banks are going to be able to take back from us. But these are typically going to have interest rates. There's going to be a reason that they're giving you an unsecured loan or an unsecured line of credit. Secured, guaranteed by collateral, such as a home, guaranteed by collateral, higher credit limit. If the borrower defaults, lenders can seize the collateral. Car loans, mortgages. Unsecured, not guaranteed by an asset, typically have higher interest rates, have lower credit limits, more difficult to get approved for. Example, credit cards. So that's why we do a lot of credit funding for people that don't have a lot of revenue or don't have assets to lend against. All right, now we're going to do non-recourse debt versus recourse debt. So you guys know what this is. Okay, so a non-recourse is a type of loan secured by collateral, commonly property. If the borrower defaults, the issuer can seize the collateral but cannot seek out the borrower for any further compensation, even if the collateral does not cover the full value of the default amount. Okay, so if you're ever buying a house, you really want to make sure that you can get a non-recourse loan, especially nowadays with the market being as funky as it is, because a lot of the stuff that happened in 2008 is they would loan people houses. The value of that property went way down, and then the banks would try and collect. They would sell the house at auction, and then they would be able to come after the people for the remainder of the bill, okay, because they didn't know what they were doing. Now, full course debt, that is a type of secured debt that gives the lender rights to assets beyond just the secured collateral. Okay, so that means that they give you a loan on the house, and then let's say you can't pay the house, and then they basically sell the house, but you still owe them money. The banks will come after you for the rest of the money, right? These are the big differences. Okay, so the non-recourse loans offer borrowers the advantage of not being personally liable for repayment of the loan if the loan defaults. A lender may foreclose on a property in the event of a loan default, but the borrower's credit score will not be impacted. The main disadvantage of a non-recourse loan is that the borrower may receive less favorable loan terms. Non-recourse loans can be more complicated for partnerships and syndication. Okay, so it's like if you're trying to get a cosigner or something, they're typically not going to do the full recourse. But if you do get a cosigner, they're typically going to do a full recourse debt, meaning if you default on the loan, they're not only going to come after you, but they're also going to come after your cosigner. Okay, this is important stuff to learn and just kind of understand and have an idea of. Personal guarantee, PG, versus Uniform Commercial Code, which is the UCC. Okay, a personal guarantee is a provision a lender puts on a business loan agreement that requires owners to be personally responsible for their company's debt in the case of a default. Okay, this is another reason why when we do business credit, when you do business funding, some gurus or funding companies out there will tell you that, oh no, these credit cards are not personally guaranteed, but come to find out they are. Okay, there are only certain credit cards and certain banks that will give you credit cards that are purely based on the business that you do not have to PG for. Okay, so make sure you're working with a professional like myself when you're doing your funding, or know what this is, because a lot of times you'll apply to some credit cards that say it's a business credit card, but then you get the inquiry on your personal credit. The typical red flag is if you have to put your social security in on any applications, then that means that you are personally guaranteeing that debt if the business cannot do it. If you're only putting your EIN number in, then you're going to basically know that this is strictly a business loan and that they will not come after you if the loan defaults. The UCC filing, Uniform Commercial Code, is a form of notice that lenders use when securing a borrower's loan with an asset that lenders use when securing a borrower's loan with an asset or a group of assets. This enables lenders to seize the listed property as a way of recouping loan funds in the case of a borrower's default. Okay, so those are typically, let's say you're going to basically leverage two of your properties to go buy another property. Well, you use the other properties as collateral, and that's what the UCC filing is for. Pre-qualifying a borrower. Okay, so this is more for if you're a loan broker and you're trying to figure out, which route do I go to fund to this person, or you're trying to fund yourself. Okay, credit-based funding, basically pre-qualifying. You're going to be looking for any derogatories. Okay, which a derogatory is just a negative, like a late payment or a collection or a charge-off. You're going to be looking at the utilization. We typically want utilization below 15% before we apply to anything. The age of the file. You need to be at least 2 years in business typically to get business credit. And then the number of inquiries, right? So if you have more than like 3 inquiries, your likelihood of getting approved goes down drastically. Revenue-based funding. So if you're trying to get somebody a loan just based on the revenue, this is what the bank is going to look at. They're going to want at least like 3 or 4 months, sometimes more, 6 months of bank statements. And what they're going to be looking at is what's the average balance of basically giving these deposits. So what's the average balance and number of deposits? Okay, so like if you're really trying to get business funding based on revenue, not based on your credit, you want to have a lot of deposits. Typically, they want more than 5 because you could just have a business, but there's no deposits going in. There's no money going in and out. And that looks weird to these banks, right? The banks are going to look at these kind of things. And then the number of negative days. So you never really want to have a negative day in your business bank account because it will leave a red mark for like 3 months, right? So that's kind of a red flag to business owners. Okay. You also want to have time in business. You also will check your credit score, right? Or your credit report. And then also what type of business, right? There's certain types of business we talk a lot about that just cannot get funding, but we've found ways to go around it. Some examples are the marijuana industry, the trucking industry, real estate industries. The banks don't like to fund to these industries anymore because they've just been burnt so many times and there's just too much risk. So they don't even fund to these companies at all. There's also businesses that specifically only work with types of companies. There's banks that will only lend to doctors. There's banks that will only lend to construction companies. There's banks that will only lend to restaurants and stuff like that. So the type of business that you put in when you're starting your business is very important. Asset-based funding, they're going to look at your credit report. They're going to look at your income. Can you afford this property? And then they're also mostly going to look at the asset, right, that they're lending against. So if the asset has a lot of room to make some profits, you're going to be in the clear. But if there's not a lot of room, if the assets are risky, you're not going to be able to do it. And then the type of asset, is it a car? Is it a house? Is it a mobile home? Right? Okay. And this is basically just a refresher on what builds up your credit score. Your credit score is built up 10% of new credit, 15% of the length of your credit history. 10% is credit mix. So this means how many credit cards, how many loans do you have? Is it a good mix? 35% is your payment history. Okay. This is why if you ever get a late payment, it's almost the worst thing you can do for your credit next to getting a bankruptcy. Okay. So late payments are a really big deal. So if you have more than 2 late payments on a credit card and you have a small credit card, I would almost recommend that you just throw that credit card away. Not throw it away, but close the account and remove the credit card from your credit file because it will hurt your credit when you go into funding. And then 30% is amount owed. Okay. So you want to have a lot of available credit, but you don't want to have it all maxed out. That's why utilization is so big. Payment history is so big. New credit and all this stuff is just important. But this is what builds up your credit score. Okay. So this is revenue-based lending. Okay. And this is basically the breakdown of what it looks like and what you're going to be doing. And this is kind of the matrix for what the banks are looking for when you're trying to get stuff. Okay, what type of loan are you trying to get? Personal, business, right? It can be any of these things. Business type, all types, doesn't matter. Nationwide, credit profile, B+, all types. Terms. So typically if you're doing a revenue based income, you want to be in business for at least, or you want the loan to be at least 1 to 5 years. That's typically what it's going to be like. If it's credit-based, there's really no limit. Interest rates. So you see how asset-based interest rates go down because they have something to go against. And then basically if you're doing revenue, it can be 8% or higher or 9% or higher. And these kind of things can change all the time. Really? Great. So these are the kind of the matrices that you're looking for. Another example of what these kind of look like is like if you go to Google and you want to look up Fannie Mae lending matrix. This will tell you what people are basically looking at before you apply to them. And the lending matrix essentially tells you what it is you're eligible for, what you can do. Well, this is kind of what it looks like, right? So if you're trying to get a loan with them, this is kind of what it'll be. If your credit score is above, like a 760, looking at very low interest rates, loan features. If your credit score is lower, you're going to start getting higher and higher interest rates based on how much you're trying to get. The loan features, what kind of houses are you trying to get, right? So this is just so you can kind of learn more about what this is. So, I mean, this is just kind of good information for you to understand what you're looking at when you're really looking at different kinds of lending opportunities, right? And what happens. Collateral for credit-based, you don't need any collateral. For asset-based, obviously you need collateral. Income verification for credit, you don't necessarily need income verification. Whereas if you're doing revenue-based, of course, you need to have income verification. Asset-based, they can lend strictly against the asset, but it just depends on transaction-based or what it is. Age of the credit file. So this is why whenever we go into funding, we typically honestly want 2 to 5 years on your credit history before we start funding. Revenue, you need at least 3 months of business because you want to show at least 3 months of bank statements showing that your business is making money. Asset-based is purely transactional. Okay, time in business. This is why when we do funding for new businesses, we almost always go based on the credit, either the personal credit or the business credit. So you don't have to have any age yet if we're just going for the credit for the startups. Essentially, if you're trying to do revenue, you need at least 3 months. Asset-based doesn't matter. Credit inquiry criterias. You don't want any inquiries within the last 6 months before you go and apply for new stuff. Revenue doesn't matter about your inquiries. Asset-based doesn't matter about your inquiries. UCC filing, only thing that matters is transaction-based. Prepay penalties, funding. All right, now let's talk a little bit more about business credit. All right, business credit cards. If you want to fund a business up to 100K and you don't want it to report to your personal credit, you want to build your business credit, pay the amount and get 0% interest, then you got to hit us up. Because these are the kinds of funding that we do, right? We get business owners, startup business owners, 0% interest credit cards, and they can typically be up to even 24 months, right? And this is really what you want. But in order to get business credit cards, you have to have either good business credit, you have to have your business set up, or you have to build up your business's credit properly. So unsecured credit lines, this is what you really want to be looking for. You want to have no derogatory late payments, right? No derogatory items on your credit report. No late payments, no collections, no charge-off, no tax liens. You want to make sure your utilization is below 15%. You want to have an age of your profile at least more than 2 years is typically what we want. And if you don't have 2 years, then we're going to have to probably buy trade lines or boost your credit score or just be patient. We have to remove all your inquiries, and we want to make sure that your inquiries are not reporting. All right, so here's the revenue financing matrix. All right, minimum time in business, when at least 3 months, because you need to have at least 3 months of bank statements before you can get approved for a revenue-based business loan or business line of credit. These are typically what you want to do. You want to have at least $10,000 is what I would always recommend. I don't really tend to do loans less than $10,000 because it's just not worth my time. But I can help people get these kinds of loans. And you can get up to, $500,000 or more. Lifetime value, no lifetime value required. Most businesses are considered for these kinds of things because, again, it's based on your revenue, right? You can find these loans nationwide. The interest rate typically depends from 8 to 25%. I would never recommend getting a 25% loan. That's just crazy. The rate can be factored. The term, either 2 years, 3 years, 4 years plus. Underwriting, this is what the underwriters are going to look at. Business must be in operation, right? That's why we always have to make our businesses look like they're legit, like they have a good address, they have revenue, they have a website, they're on social media. You want to do everything you can to really look like your business is doing work, right? You must have cash flow. You must have funds that are hitting your bank account at least 2 to 30 within the last, or at least 2 deposits within the last 30 business days. Okay, in order to get approved for revenue-based funding. Average bank account balance needs to be at least $2,000, right? So that means on average, you need to have $2,000 in the business bank account. Revenue-based funding matrix. All right, same thing. You really don't want to have any derogatories, no late payments, no judgments, no bankruptcies on your business. Your utilization should be below 15%. You want to have the age of your profile at least 2 to 5 years, and you want to have as little inquiries in the last 6 to 12 months as possible. Revenue, it's only 10% for inquiries. So revenue inquiries don't matter as much. That's why whenever we do funding, Typically, we do business credit, then we do personal credit, and then we'll go for the loans and stuff like that at the end of it, because the inquiries don't matter as much when you're trying to get a loan or when you're trying to get these lines. So this is for asset-based lending now. Okay, so this is something I wish I would have had when I started, but this is basically everything you need to know, right? So a conventional small balance. So these are for smaller loans, for agencies, larger ones, and then private money, right? So primary, these are for anywhere from 200,000 to 10 million. Types of property: offices, retail, commercial, condos, industries, so on and so forth. Something that's a little bit bigger: multifamilies. These are going to be like your commercial loans and stuff for 10K up to 5 million. This is what you're going to want to get. You're going to want to look at the purchase. You're going to look at what the refinance or the cash out is going to be. So this is really what you want to know. You want to know what kind of credit do you need? Typically at least a 640 plus if you want to get a conventional regular loan, right? For SBA, doesn't matter quite as much. They just really want to make sure that the loan to value is at least 90% or more. Basically interest rates. This is why SBA loans are so good. They have typically lower interest rates. These are also for primary, regular housing and things like that. You can do foreign, you can do national. They'll take your money. They don't really care. Nationwide. This is just very cool stuff. So you guys can take a look at this and kind of break it down for yourself. For HUDs, and this is for like what private money typically looks like as well. Purchasing, refinancing, and stuff like that. No collateral is needed for the typical primary loans and stuff like that for the primes. Whereas if you're doing private money, typically they always want collateral, right? Some sort of cross collateral or something is going to be required. You know, for foreigners, private money is always good for foreigners. They don't care. They'll take your money. Whereas if you're trying to get a loan, regular style, you need to be in the US. Interest rates, blah, blah, blah. Terms, 1, 3, 5, and 10 years. All these things can be different. Private money, you can get up to 25 years, which is pretty cool. Prepayment penalties, varies on the bank, eligible on location, so on and so forth. So this is, again, if you're trying to buy commercial properties or something like that, this is typically what the underwriters are going to be looking at. They're going to be wondering, you know, is their credit score at least above 640? Yes. Do they have any collateral? Not necessary unless you're going for something bigger, like a multifamily or a warehouse or something like that. This is all pretty cool. This is useful information. You can pause here and you kind of look at this and get a breakdown of what the difference is between these kinds of things. Again, the SBA is backed by the government for HUD properties and stuff like that. For investors, for $500,000 plus, you can get bigger ones. CMBS, non-conforming, bridge loans. This is kind of what you're looking for private money. This would be like hard money lenders and stuff like that. No restricted property types, except for, you know, people that are living in them. No restrictions, stuff like this. This is very powerful stuff. So now we're going to talk about equipment financing. Now, equipment can be all kinds of stuff. I know you typically will think of like backhoes, but there's lots and lots of banks and businesses out there that need equipment financing. Okay, so this is what they're looking for. Gyms, you know, they have all those different kinds of workout things. They all are not just buying those outright. They're typically leasing them or they're getting them financed. Hospitals or healthcare companies almost always need equipment financing, which is very powerful for doctors and things like that are trying to grow their practice. Restaurants, they always need a new equipment. So just any type of business that has large equipment, they're almost always financing it. Right. This is one of the biggest ways that you can break into a very profitable business as a power loan broker, because you can help these sorts of people get financing for their equipment. Right. So typically the equipment is, number one, it's going to be credit-based equipment financing, but there's also ways to get financing without being credit-based. It can be based on the revenue. It can be based on just a lot of things, okay? Credit-based equipment financing is almost less expensive than collateral-based equipment financing. Credit-based means that if you have okay credit, in most cases, you can finance your equipment. And what's cool is you can help people do this as well. Right. So this is how you can basically reach out to people that really want new equipment for their business. Or, you know, what I'll do is I'll go onto Facebook Marketplace or Craigslist and I'll find people that are trying to sell their equipment. Right. And then I'll basically say, hey, look, if you have somebody who wants to buy this, but they don't have the money, I can help you finance it. And that's a way that you can make easy money as a business loan broker. Right. And it's super powerful. Typically, you need at least a 650 credit score or above. But sometimes if you have money or if you have a good business or you have some sort of proof, they don't really care what your credit is. It's mostly backed by the equipment, right? So you just have to be able to show that you can make payments and you'll be able to do it. Cash flow based financing. Okay, cash flow Does not really matter what your credit is. Sometimes they'll still check your credit, but it's not as important. But what you can do is if you have a lot of cash flow, they'll be able to lend it to you, and you just have to show that you make on-time payments, or you have to put like a deposit down, and then you can get the equipment for people. Collateral-based financing. So for collateral, you would use the business as a collateral, or you would use your real estate as collateral, or some other form of collateral, or other equipment even you can use as collateral, basically telling the people, hey, give me this equipment. If I default on my payments, not only will I give you, your money back over time, but I'll also give you all this other equipment, and you can start to get financing that way. Story-based would be like having a really good business plan, or having somebody vouch for you, or like a rule book on how you're going to use the equipment to show a profit. And sometimes you can get that as well. Another one that's interesting is how you can do, it's called ROBS. And you can get how you can basically get funding against your 401k. Okay. ROBS stands for rollover as a business startup. So let's say you've been working for a company and you have all your money tied up in your 401k, and you can't pull it out though until you're like 50 or whatever, because that otherwise you'll get a huge penalty. Well, instead of taking out that penalty, you can basically get a loan against your 401 and for 401k, and you can basically use this as financing, which is incredibly powerful. And what a lot of people don't know is you can actually, as your own business owner, you can set up your own Roth IRA or your own 401k for yourself, and you can deposit money into it, right? So you can actually have it invested in the stock market. And then once you get to a certain amount, you can actually get loans against your 401k. And this just becomes another way that you can use the money that you already have sitting in there as active working capital, as opposed to just investing it, right? So this is how the rich get richer. They put money in, they don't take it out, and then they just get loans against it. And it's very, very powerful. The way that works is you have to set up a C corporation. Then you have to set up a 401k plan for your C Corp. Roll all your existing funds into your new retirement plan. The company will buy back stock from the C Corp, and then you can use this funds to operate your business. Very, very powerful. You can learn more about this. Just look up ROBS and look up 401k. It's a super cool way for you to make more money with your 401k and to fund your business. And if you just have a lot of capital, this is how you can make your capital safe, and then you can get loans or lines of credit against it, and you can basically use your money multiple ways, right? It's all about leveraging your money to make more money. Very, very powerful. Has to be a C Corp. The max you can do is you can only contribute like 25K per year, right? So you have to basically work out which ones you're going to use, and then you can basically get loans against it, and it's all legal. All right. And last and final one is going to be a settlement loan. Okay. So this is if like something happens and you're getting sued and you don't have the money to pay the lawyer, or all your funds are tied up and you just need to basically get a loan to hold things together until the settlement is taken care of. Basically, this is a way that lawyers can make sure that they get paid when they're doing legal work, right? So that's what a settlement loan is. But you can help people get settlement loans while they're going through court, while they're going through this kind of things, while negotiating is going on. Okay. If you're in the middle of a lawsuit, you have a judgment, you need money to cover living expenses, a settlement loan, sometimes called a lawsuit loan or pre-settlement funding, litigation financing, is an option to help clients get financing. You can basically do all this kind of stuff. Drawback settlement loans are typically high interest, right? So they're going to be very high. Again, this is so like your lawyer can get paid so that you can live while you're going through a loan until you get the funds, right? People sometimes that are going through divorce can use this. Sometimes people that are getting sued by a business can use this. There's lots of different ways that you can use these kinds of interesting things. If something terrible happens and someone passes away, but it's not your fault and you can't pay any of your bills, that's when this would come into play. Medical expenses, car accidents, personal injury. If you get hurt on the job and you're waiting to get paid out from the business, then you can use one of these to basically pay your bills until the company pays out, right? And then actually, this is the last one. So stock security loan matrix. This is what the rich also do. They basically invest all their money into stocks. And instead of pulling their money out of their stock portfolio, this is how actually Elon Musk bought Twitter, is he had all of his stocks in Tesla, right? And instead of cashing in all of his stocks in Tesla, he essentially used his stocks in Tesla as collateral and got the funds that he needed, as well as millions and billions of dollars from all these other people to buy Twitter. So this is what the smart people do. They keep all their money invested, but then they get loans against their money and their stock portfolio, and they were able to get funds to stay afloat. Some advantages: you can access cash without the potential of capital gains tax. You can get typically lower rates. The downside is that these are interesting. These are based on the stocks. So if the stock market absolutely crashes, they might call that you have to pay this back right away. You can use this to pay taxes. You can use this for financing. You can use this for debt consolidation, education, business financing, and all kinds of stuff. So this is very cool way to use your investments to make a lot of money. So those are the 3 paths to lending. And now you guys have a good idea of the different ways that you're able to get funding, and you have a little bit more of an education on what you're looking at. All right, if you guys are interested in starting your own finance company, go to powerbrokers.io. And we actually have this explainer PDF that kind of breaks everything down, right? So Power Brokers, check it out. We have an amazing school community. We have lots of things. I'd watch this video, download the explainer PDF. But we're just helping people start their own finance company. Okay. So it's not just about loans. It's not just about credit. We'll also teach you how to make, 10 to 50,000 to 100,000. The potential is unlimited, but you're going to be able to start your own financial business, right? Helping other people get access to capital, helping people get access to credit cards, get access to loans. And you're just the middleman. You don't use any of your own money. You just use your time and your expertise. And it's just all about understanding the finance game for yourself, but then helping other people become successful and become a power loan broker. Okay. We also teach you everything about credit repair. We teach you everything about how to set this business up. I'm even going into how to create a finance affiliate company so you can basically make passive income with this kind of business model. And it's just changing people's lives all over the place. So check out powerbrokers.io. I hope you guys enjoyed this presentation on the 3 paths of lending. I'm going to be doing another one of these, I believe, tomorrow or the next day on credit repair and some other stuff. So let's get after it. Let me know if you guys have any questions. Hope you guys enjoyed. Until next time, peace.